Yes, good afternoon, members. It's exactly 2, and would like to start this session. On behalf of MURBS, I warmly welcome you to this online member sensitization session. We are grateful that you have joined us virtually for today's important discussion on building sustainable wealth through financial markets. And as we start off this session, kindly allow me to keep a few housekeeping notes before we begin. Please ensure that your microphones remain muted throughout the session unless you're invited to speak. And also maybe when you want to make a submission, you can just raise your hand and then you're able to speak. You're given permission to speak. Kindly use the chat box for any technical issues or questions that may arise. Maybe you're not listening, you're not hearing the speaker at a time. You can be able to raise any technical issues and also questions that you have during the session. We encourage active participation during the Q&A session, and also ensure that you have a stable internet connectivity where possible. And so to start off, we are going to commence with the prayer, with the word of prayer. And I will be giving that prayer for this session. Okay, you can humble yourselves. Heavenly Father, we thank you for this day. Thank you for your goodness, for your mercy, for your faithfulness. As we're going to have this session, we'll pray for your wisdom, for your understanding. We pray that this session is insightful. We pray that you're able to enable the speaker to share information that will be useful to our members. And I pray that the members get this information and actually put it into practice. I pray all this believing and trusting in Jesus' name. Amen.
Amen.
Okay, thank you. Ladies and gentlemen, we now move on to the welcome remarks according to our program. It is my pleasure to invite the Secretary Board of Trustees, CPA Francesca Angida Mujema, to deliver the official welcome remarks. Let us give her our virtual applause. You can have those clapping hands there. Feel free to use the clap reaction icon. Thank you very much, CPA. You're welcome.
Thank you very much, Rebecca Nairoba. Ladies and gentlemen, Rebecca has already introduced me. I'm CPA Angida Francesca Mujema, the Board Secretary. We are honored as MURBS to have you here, all of you. Yeah, I think I just wanted to connect the face to the voice. Now I can switch off my video and proceed. Yeah, today we are having our Q4 member sensitization session, as we have been announcing, and I'm glad to have all of us here. Yes. I want to welcome in an official way and a special way all of the members. I'll begin with the trustees present in the house. Any trustee present in the house, you're most welcome. Yes, also members of the university management, I honor you and welcome you to this session of the member sensitization. I'd like also to welcome association, staff association executive leaders, all members of the scheme, the secretariat staff. You are all most welcome, because it's not taken for granted that you find time to come and listen to matters pertaining to the scheme. I will not hesitate to keep reminding us about our vision. MURBS' vision is transforming members' lives for a fulfilling retirement journey. To fulfill this, therefore, we conduct member sensitization sessions. That is why I applaud all of us who keep it a point to keep coming here, because we want to make sure that we get our lives transformed as members. And today our topic will be about building sustainable wealth through financial markets. We have been used to those other wealth of making houses, rearing goats, rearing cows, making houses for rent. But today it's a different matter altogether. We are going to talk about building sustainable wealth through financial markets. We shall have to hear it all from the horse's mouth. And before I go any further, members, I would like to bring to your attention our recent developments in the scheme. As our members, we are accountable to you, and we keep updating you on whatever development that takes place. We had an International Women's Day celebration with a topic which was so insightful. Members participated in that financial empowerment session, which was facilitated by Dr. Ruth Aisha Kasoro, and it was focusing on personal growth and financial wellness and also retirement preparedness. This was on the 6th of March 2026. Yes, as we were there, we really had a blast, and I'm sure the ladies in the house, you must have made a step to implement what we learned. Personally, I started on something small. We also had ambassadors consultative workshop where ambassadors engaged the departmental ambassadors to review MURBS. We engaged all the departmental ambassadors from cohort 1 to cohort 6, 7. Then, and we reviewed the proposed ambassador program policy framework, which was aimed at strengthening member engagements and also professional development. It happened on the 31st of March 2026. Yeah. Members, also, I say our annuity meet and greet session happened on the 29th of April 2026. This one is whereby members. Yes. What is it? Should I proceed? Okay, sorry for that interruption. The members attended an interactive session on retirement income solutions. They were gaining insights into how the annuities provide guaranteed income in retirement, and also learning from testimonies which were shared by annuitants. Members, we have been telling ourselves that when we go, it's not necessary that we can have to go with all our money. We can go enter into that annuity program whereby we keep getting our salaries. When I attended that session on 31st or rather on 29th of April 2026, last quarter, we had people's testimonies. People were saying every month they hear that calculator and they go to the bank and they get the money. Please, those of us who are about to retire, don't miss out from that insightful program of annuity. Also, we made the trustees have always had a tendency to interact with our sponsor. So there was a meeting that happened. It was convened to discuss some strategic priorities and also the scheme performance. We keep updating the sponsor like the way we are updating you members. We time to time update our sponsor. We updated them on our performance, on our governance matters, and initiatives aimed at enhancing member value and also long-term sustainability. We keep updating our members on every step we take. Also, we are going to have the end of the year financial end of 2025, 2026. Today is 25th. We very well know that our financial year ends on the 30th June 2026. So we're about to end our financial year. We are in big preparations and want to report to the members that as we speak now, all our contributions for the financial year, for all the 11 months from July 2025 to May 2026 have been remitted by the sponsor, and all the money has been credited to the member accounts. You can check your accounts. And also May was credited. On member counts, it was also done this week. And also, I'm glad to report to you members that our June salary, I got mine yesterday, although we have not yet credited the members, but member counts, but I'm sure it will be credited immediately. And I want to urge anyone who could be having, in case we get any problem or any query, any member who has a query regarding your individual contributions, please feel free to contact the scheme officers. They have put their members who, sorry, some of the members who keep getting lost going to the other place. Please be informed that we shifted. And also there is a QR code which can give guidelines on accessing the portal. That is the office location. Our new address is there, the Fig Tree House along Pool Road. Please don't go to Lincoln. And the offices are always open between Monday and Friday from 8 to 5. Please go there in case, please follow up on your contributions. We don't want to hear that anyone missed out on anything. Yeah, and then also accessing your portal is also possible that you can have everything from there. Another point to make, another upcoming activity, we keep having these sessions, and we shall be having another one on the 16th of July, 2026. That will be entitled Know Your Scheme. Members, please make it a point to interest yourself in knowing your scheme. You need to understand MURBS mandate. We don't want you to remain behind and you keep asking, because how do they do this? Now does the contribution come in? How do they do? We really not get to know all about your scheme so that you are not left behind. Understand much about your scheme, how your money comes in, how it is being invested, how it is going to, how you're going to receive it. We keep educating people, because now someone didn't know about the annuity, but now when you keep understanding what happens and what the scheme does, it becomes good for you, so that you don't even have to ask things which you really should be knowing. You need to know that this is what I'm entitled to. This is not what I'm not entitled to. Yes, we should also have another member sensitization session on the 20th of August. That we should inform you about the topic that will happen on that time, but still to be regarding our scheme matters. Then, last but not least, also we are preparing for annual general meeting, which is going to happen on the 29th of October, 2026. Kindly mark your calendars. You shouldn't miss to listen to matters pertaining your investments in this scheme and your retirement is concerned, as far as your retirement money is concerned. So, for this quarter, 2025-26, sensitization sessions have taken place quarterly. I want to remind you a little bit of those sensitizations of the topics that we had in September 2025. In case any of you missed out of all these sensitizations, you can get in touch with Nairobi Rebecca. He will give you recordings and you will listen, so that you can be at par with the rest of us, because these were all insightful. We had a holistic approach to health and retirement readiness. It happened in September 4th, 2025. Traveling beyond work, preparing today for fulfilling retirement tomorrow. That is, first of all, I should have told you our theme. Our theme for this year, our theme is thriving beyond work, preparing today for fulfilling retirement tomorrow. That is our theme as MURBS. We strive beyond work and we prepare today for fulfilling retirement tomorrow. As you do everything, we keep this at the back of our mind. Then we had those sessions in September, Jan, March, and then today. In September, we had a holistic approach to health and retirement readiness. In Jan 2026, we had understanding identity shifts, psychological adjustment to retirement. In March, we had Beyond the Payslip, turning your side hustle into a sustainable income. I loved that one. We grabbed the chapati making, we grabbed the, oh my God, tomato selling. We are really smiling. We really thank MURBS, Secretariat and trustees for having brought these things for us to learn more. Then today, we shall have building sustainable wealth through financial markets. I can't wait to hear that. Thereafter, about the topic of today, what are we studying today? Building sustainable wealth requires more than saving money. It requires making informed investment decisions that allow money to grow over time. As financial markets continue to evolve, individuals have access to a wide range of investment opportunities that can support long-term financial security and retirement preparedness. This session, therefore, will provide practical insights into how members can navigate financial markets, how we should understand investment options, how we should manage our risks, and how we develop disciplined investment habits that contribute to sustainable wealth creation and financial independence. What should be our goal? Our goal, therefore, is to equip members, to equip us who are attending today with practical knowledge and confidence to make informed investment decisions, to build sustainable wealth, to enhance financial resilience, and to strengthen preparedness for a secure and dignified retirement. Yes, dignified retirement. Who is now our facilitator? Our facilitator today is Mr. Godfrey Bukomeko, who is an accomplished investment professional and financial advisor. He currently serves as a senior portfolio manager at Old Mutual Investment Group, OMIG, Uganda, which is the largest asset management firm with over 5 trillion in assets under management. OMIG is also a fund manager of MURBS. Of the two fund managers, OMIG is one of them where Godfrey works. Godfrey possesses an extensive experience in investment management and financial markets, playing a key role in driving investment strategy, portfolio construction, and fund management. Working closely with institutional, pension, and private clients. Today, he joins us to share insights on how members can leverage financial markets, investment diversification, and disciplined wealth creation strategies to build sustainable financial security. Without wasting any other time, members, join me to welcome Mr. Godfrey Bukomeko to come and speak to us. Godfrey, you are most welcome. Thank you very much, members.
Thank you, Chair, and welcome, members. My name is Godfrey. Allow me just a minute to share my presentation.
Rebecca is telling us that we can even access these sessions on the YouTube channels, so we are good to go.
Thank you. Please confirm you can see my screen on your slide.
Yes, we can see your screen.
Okay. Thank you. So I'm going to share my turn on my camera just for a bit, just so that members can know who they're interacting with. And to note, this particular session is going to be a bit interactive. I'll try to break down the complexities in the wording or in the jargon so that it's a bit easier to digest. And it's really centered around just building how to build really sustainable wealth through financial markets and manage your own cash flows, and how to really get to make sure that you're working towards a definite wealth goal in your personal finances. But keep a few takeaways as we start. Firstly, most people, when they're starting out in life, we tend to believe that the solution to our financial problems is earning more money. Okay, that's good. So we tend to believe that the solution is earning more money and simply aspire to either get promotions or invest money exclusively into more and more risky or riskier investments just so that we can improve our income. But that does not necessarily translate into building wealth. There is a whole gap between income and net worth. So, and this gap is influenced by how well you apply the practical takeaways or the practical insights in terms of how you build wealth. One of those issues or aspects is how you firstly avoid lifestyle inflation. So when you're starting out working, you're probably using a taxi to go to work, and then once you get a promotion that you're really asking for, you then take out a car loan, and then once the car loan comes on board, it starts to creep or to eat away a big chunk of your paycheck, and eventually you take a school loan, and then from then on you take a mortgage, and you will end up spending 25 years of your life in a borrowing state, meaning you're always going to be carrying liabilities that you have to keep on getting to settle. So it's key to keep, as you take this journey of sustainability in personal finance, to really watch how you spend so that you can avoid the need to borrow. And then on the other hand, I'm going to give an example. The money you save, oftentimes you count it as money that you have. But what builds wealth is not the money saved only. It's important how you allocate the money. So I'll give you one scenario here. For someone who is 24, 25, 26, if they earned 20 million shillings or managed to save up, say, 20 million shillings or 15 million shillings, they could invest that in a piece of land. But chances are the return on that piece of land after, say, 7 years would be 100%, which means the land would have gotten to double in price. But if they invested that money in themselves and got a master's degree, they could improve their income from, say, 2 million shillings to easily 10 million shillings in the same time, which means that the return on investment far outstrips the 100% that they got on the land. So how you allocate your money is very important. And one of the things, and we shall look into as we continue the presentation, we shall look in and just try to appreciate what factors do you need to consider when you're allocating your savings or the money that you've managed to get. Then as you go through your financial journey or as you grow, it's important to note at any one point that what normally causes strain in personal finance building is anxiety or fear that comes from actually personal mismanagement. So how long you can survive if your income stops coming in is critical. But most people solve this problem by way of saying, how much have I saved? And therefore, if I've saved 5 million shillings, my expenses per month are 1 million, therefore I can survive for 5 months. That is the first level of answering this question. But the better point is to say, if you need 1 million shillings in expense per month, how do you set up assets It could be a mobile money kiosk. It could be a fixed income. It could be something in the financial markets, or it could be something in the real economy. But how do you set up an investment that has a cash flow that would be able to cover that 1 million per month? Now, if you have an asset that can get to cover that, then you'll have reached the next level of solving that particular problem. These are just reality checks in terms of this journey of building sustainable wealth that people are actually facing, and would like, at least as we take this journey, to all consider this. Now, how is wealth formed? Because like I said earlier, earning a high income does not necessarily translate into having financial freedom or into having a high net worth. Most people who you actually see earn a high income have a sort of sitting on a double-sided problem, in the sense that they also have high expenses and high expectations from society. So they do not get to take the journey of this world, of this wealth equation properly. One of the things to consider is, yes, income, but of that income, how much are you keeping? Because the money that you keep is the one that is yours. If you earn 5 million, if you earn 1 million shillings and you spend 600,000 and you keep 400,000, that 400,000 is the one that is yours. It's like a seed you've obtained that you can sow, and it will get to germinate, grow, and give you high returns later on. The next is that money that you've saved. How are you investing it, and at what return? Now, the better your investments or your investment strategy is, the wealthier you are going to get, or the easier it is for you to actually build wealth. So wealth is not only built by earning more money, it is actually built by how you save and deploy that money. So, and you can deploy this money into the financial markets, or you can deploy this money, actually in many ways, even if you deploy into the real economy, you'll still need to deploy some money into the financial markets. Now, the other pillars of building wealth is, you're supposed to look at your portfolio or your personal life as a portfolio. What do I mean? When you must have a system around you. Yes. So firstly, if you're going to be able to save money, you need to be able to run a budget. Yes, you need to be able to have insurance for critical problems or things which could occur and significantly take you back in your financial journey. For example, if you have a car, you need to have it motor comprehensively covered, because if you then were involved in an accident, you would know that you can replace the car without digging into your savings, which would be important. You have to build a buffer, a capital buffer. Now, this is interesting because a couple of people want to do things. You want to buy land, you want to invest, I don't know, in a restaurant, you want to invest in equities, in fixed income, in bonds, but you haven't built a capital buffer, which makes your wealth building journey difficult. So in your budgeting, you have the savings, you have the capital buffer, but you must have the protection. This protection helps you. So I've given an example of a car accident, but also there are medical challenges. Say you then discover that you need to pay 2 million shillings in a hospital bill, but you've only saved up 4 million shillings in your journey to say getting to 10 million to make a critical investment. It makes it difficult for you if every time you go to hospital you pay money that is coming out of your saving. It makes your journey very difficult to really achieve that. On the other side, personal development remains a critical one. This is not only for the young people, but even for people who are at least in the afternoon of their lives. Personal development pays a significant return on the income side. Yes. But I'll say this, building sustainability in finances is a process that is firstly very, very simple, but in its simplicity, it is boring and repetitive. Now, because why do I say boring and repetitive? Why use those choice of words? A lot of the good decisions you make that will actually return or yield very good progress in your personal journey are going to require you to repeat them every other day and every other time. For example, if you're running a daily a daily register of all your cash spent. So even if you buy airtime, you write it down. Even if you buy a chapati, you write it down. You will find that that process gets to be a bit repetitive, and therefore it's going to bore you. Now, it's critical that you go through that process because it will get to create a discipline around you. It will enable you to ask the right questions to the different people around you and enable you to compound your growth and therefore your wealth. Yes. Now, I've spoken into the budgeting cycle, and what you need to appreciate is from this is most. I'm going to give a personal example here. When I was working at some point in one of the banks, we did a survey or a study and discovered that of the over 2,000 employees, over 2,000 employees, about only 5% didn't have debt. And these are people who work in a bank who appreciate the effect of how debt can creep into eat your savings and make it difficult for you to achieve your goals. And you find that only 5% didn't have debt. And of those 5%, about 4% had simply not yet qualified for the loans, which meant that these people were not financially free, even after having worked 15, 20 years in the financial space. Now, what was the critical role or critical purpose for getting these loans? One was for recurrent expenditure, people borrowing money to pay school fees, people borrowing money to buy cars, people borrowing money for critical family emergencies, and people were borrowing money for mortgages. Now, you will find that for most of the people who are even getting money for mortgages, they did not have an income problem. They were actually earning money that if they manage very well over a 3 to 4 year period, they'll be able to build these houses. But when they took these loans, they were actually encumbered for 20 to 25 years. So in your financial journey, you shouldn't avoid debt, but you must be very careful on the purpose of that debt, the terms of that debt, and ask yourself whether if you simply waited, you wouldn't need to take on the debt. Because what the debt will do, it will make it very difficult for you to continue to grow your balance sheet. Personally, one time I took on a loan and it was for a car. Now, when I did the math on how much interest I was going to pay over time, the loan was supposed to run for 5 years. I said paid it off. I sold the car and paid off the loan in 6 months, simply because it wasn't worth driving the car if I was paying that much interest over time. If you take an example of a house, if you took a mortgage for a house and paid it for 20 years, if the loan was for 100 million as a mortgage, by the time the 20 years elapsed, you'll have paid at least 3 times that money, meaning you'll have paid out at least 300 million. Now, but also if you invested that money carefully, you find that after the 20 years, you would be the one with the 300 million, which would be a very substantial piece of investment at that point. Now, what other things do you need to watch out for in terms of the mistakes for this particular journey? One, I've already mentioned you need to have an ecosystem, because you need to have friends who also on this journey to walk the journey with you. You need to be part of circles, investment clubs. You need to be part of associations like MURBS, so that you can always be able to reinforce that discipline, that mindset, that objective. If you hang around people who are always spending their entire paycheck on, say, alcohol, you are also going to do the same, simply because that is your crowd. But if you hang around people who are actually harnessing wisdom for this particular target and objective, you are going to make it a lot quicker. The other is to avoid the lifestyle inflation. Avoid living in a house. We had a scenario, actually, this was about a week ago, where one of my friends employed a young man who was living in a house of 150,000 per month, and he was earning 70,000 per week working in a factory. Now he was promoted to earn up to 350,000 per week in the same job. What he did, a month or two later, this person finds out that that young man now lives in a house of 400,000. Meaning that's lifestyle inflation. He has improved his income, but equally, he has also increased his expense. Meaning the impact of that extra income is not going to really be as significant as it should have been. So it's important to, at any point, to make sure that you do not unnecessarily increase your expenses when you get more money. The other bit to consider is you need to separate in your budgeting process. You need to separate your money. When you get savings, do not consider them as procrastinated expenses. Now, most of us, when we save money, you put it on an account. In terms of financial markets, you can put this money in a unit trust, but you treat it as money that you're actually going to spend. It's like you're in January, you're saving 100,000 per month, but you then create an expense in June that is going to wipe out your entire saving. So that wasn't saving, that is forecasted expense, or rather expenditure that you put to the future. It's important at different points if you're able to then split your income and say, okay, this money is going to this account, which is for saving, which I will not withdraw up until we hit this particular target, so that you do not get to confuse your income with your wealth, with money that is for building your wealth. Now, you need to do all of this, you need to have a framework. And you consider yourself as an investor. One, you should know your goals. What are you saving for? Is it for retirement? Is it for a course that you're paying for? Is it a property? Is it leisure that you're saving for? Is it a trip? Are you saving for? And then also understand that you're saving for, whenever you achieve it, is it going to substantially move your life? One of the key statements that I keep joking about with people is the risk. One of the risks people run is being successful as something that turns out to be irrelevant. Say, if you are 30 years of age and you're saving aggressively, and you say in 5 years, I need to save up to 10 million shillings. Now, 5 years to save 10 million shillings is a very small target, because at 35, you most likely will have a child or a wife, and high chances that 10 million that you'll have saved, even if you succeeded at it, is only going to be able to maybe cater for your rent bill for maybe 1 year. Meaning, it may not be such a substantial win. So you have to make sure that as you set your goals, they actually are multiplicative in nature. Our varied cultures in Africa teach us how to be additive. By additive, I mean, if you inherit a piece of land, you do not want to, they tell you never to sell that land. Even if you are to sell it and make a factory that can enable you to come back and buy 100 times that same piece of land, we do not think in a multiplicative way. We say, now that you've gotten one plot, work hard and buy a second plot. You need to make plans in your wealth journey, whereby in the beginning, you're saving money to accumulate capital, but somewhere midway that journey, you start to do things that are multiplicative. For example, if you took a stake in a particular equity or a stock in the market, say MTN, and you knew that for sure this is undervalued and it's going to double in value, say in 4 years or in 2 years, that is a multiplicative strategy, because you're going to be doubling money. Now, that is what you want to be doing. Now, after you've gotten to define your goal and why that is your goal, you need to identify your risk appetite. Now, our risk appetites do vary depending on our ages. If you are if you're young, you're below 35, chances are you can take very significant risks. So from a portfolio level, you can ably allocate money mostly to high risk. Let me use an example of money lending. So you could be doing money lending, which is a very high risk investment, and count it that if you have a portfolio that's 100% money lending, that's a very aggressive portfolio when you're, say, 25 to 30. But as you get to your mid 40s, you may then move 40, 50% of that portfolio into bonds, and we shall look into the different asset classes, into bonds and things of the nature. And as you move into your 60s, you find that you don't have appetite for anything high risk. Now you want your money to be in a safe investment, earning a fair competitive return. It may not be doing 50%, it may be doing 15%, but that is considered a good return because at that point your risk is low. Now, when we say you need to set a time horizon, it's not necessarily a deadline, but I'll say this. In the journey of building wealth, the times you give yourselves, make sure you do not overcomplicate your life. And here's what I mean. Do not try to buy a car in the same year you're trying to build a house, in the same year you're trying to open up a business. You're going to stress yourself and strain your mind, and you will not be able, the only thing you'll be able to get is stress out of it. But firstly, you measure, or you measure your clothes, so you measure you get to measure your abilities, and then take one goal at a time. Say, if you want to firstly be able to save up 1 million shillings on your account, let that be the goal, however small. In a way, good strategies and good habits compound just like bad habits compound. So if you focus on the small wins and you get them, you find that, in the set time horizon, you find that you're always going to make it a lot quicker. Now, in terms of setting time horizon and goals, I'll say this as a flow that has actually been identified in psychology as a human flow. One, we always overestimate what we can do in a short time, and we underestimate what we can achieve in a long time. To put it in numbers, we overestimate what we can do in 1 year. Say if you earn 500,000 a month, ask you how much can you save in 1 year, you say I can save maybe 5 million. Because you believe that in that 1 year you'll also get a bonus somewhere or some support somewhere that will enable you to save up to 5 million. Now, you're underestimating what you can do. No, you're overestimating what you can do in 1 year. But if I ask you what you do in 10 years, you may then say, okay, I said, okay, 5 million for 1 year, so 10 years, 50 million. You're actually underestimating it because you do not know how much the compounding value would be of you actually following a disciplined process and a system and having the right people around you of your financial journey. You may find in 10 years when you can actually do 1,000 times the 5 million. Simply because of that compounding value. Now, that said, you need to make two things very clear. You need to choose suitable investments, those suitable investment choices, and continue to monitor and rebalance. I'll give you a scenario in terms of suitability of investment choices, and this is important. And this is also a real case study. Someone has a friend. The friend is a driver for say fresh dairy. So this person drives milk products from the factory to the wholesalers who then retail to the supermarkets. So this person realizes that there's an opportunity maybe in picking dairy products at 100 shillings a liter and selling them to the wholesaler at 150 shillings, keeping 10 shillings for themselves and giving the company back 140 shillings. They come to you and they tell you, can you lend me money so that I can buy more product? I've been doing this and my capital is only 2 million shillings, but can you lend me up to 20 million so that I can improve? And then I give you a better return. The products are where I work, so I appreciate them. So you'll be quick to say, okay, fine, if I give you 20 million, what are my returns? Now, you haven't considered that this investment really suit my risk appetite, my goal, and everything else. Have I done the proper due diligence on this? Is it sustainable? What happens if the guy runs out with the money or anything? But because of a good return, he will tell you maybe for 20 million, I can give you $1 million shillings every month. So you figure that you're going to make in excess of 50% in a year. So you give him the money. That's not a suitable investment because of so many reasons that we can delve into. But you'll only realize this after you've actually lost the money. You haven't gotten any collateral for 20 million. It probably took you 2-3 years to save up the money for that, to make that particular investment. So over time, if you continue making such investments, you'll find yourself actually struggling financially, not because you aren't able to build a system to budget, to save, but simply because you allocated into the wrong things. Now, here I've given examples that are in the real market, and now we're going to delve into what you can invest in terms of the financial markets themselves. Now, when it comes to the financial markets, we have what are short-term instruments. These mature in 3 months, 6 months, 1 year, and some even are available upon demand. Most of these are important when you are trying to save money. So instead of putting money on a bank account and it earns nothing, you'd rather put that money on a unit trust, on a call deposit, if you understand it, and all these other short-term deposits or investments that you can always get back your money when you need it. The other is fixed income. These are longer tenors, ideally treasury bonds, corporate bonds. You can buy a treasury bond through even Old Mutual, where I am coming from. You can buy using your bank, and you can hold them, and there are different dynamics around that. But as you get into any investment, always consult the expert, always consult the person who is mature or who appreciates that investment vehicle very well. And do not consult one person. Take 2-3 consultations before you buy it. Oftentimes when people are considering investment opportunities, they don't consider them the way you would consider a medical challenge. If someone goes to a doctor, they tell them they have a medical problem. Oftentimes, depending on the gravity of the problem, they will try to get a consultation elsewhere and elsewhere before they ever come to seek for the solution. But the same thing needs to happen when you are trying to invest in any investment. Ask a friend who you believe is well appraised of that area, of that field. Go ask an investment advisor. Investment advice is always free. If you walk into Old Mutual, anyone can talk to you and you'll get to appreciate what you're doing. So that when you're making that decision, eventually, it is actually a well-informed decision. And this will help critically in terms of preserving the capital and then also growing it. If you are to move on now that you've appreciated the different investment opportunities that do exist in your personal portfolio, you also allocated money from into your saving bucket and you're getting into investment, you need to know a few things. One, in the money markets or in the short-term investments, you're putting money that you're going to need in a short term. So even money that you would ideally have access to in case of a crisis. Then you're going to have a growth bucket, which is this growth bucket here is bigger when you're younger because then you can take on you can take on more risk and have more exposure. But as you get older, you get more into the stability bucket. You do not want to unnecessarily leverage your portfolio and then get into other challenges. Now, but I'm just going to delve a little more into the behavior biases. Yes. And this is here. I'm going to give personal examples. I'm going to give real examples so that we can all appreciate where we're coming from. So I already spoke into the lifestyle. I'm going to speak into what we call the herd mentality. Now, do not overestimate, no, rather do not underestimate the effect of the peers you have, or overestimate your discipline and personal control. as you do different investments, you will, I think you've heard of, I think it's called YFP, I think youth or something that is doing goat farming. A couple of people I know have invested in these goat farms. They do not even appreciate how a goat as an investment case is made, how you get to commercialize goat milk or goat meat or anything, but it's simply because of the people around them. So you need to be careful as you take on this journey. Make sure you have the right information and the right people around you. The other is overconfidence. Now, in terms of overconfidence, this often comes from, the fact that people who are academicians, they tend to have very good reading skills and good knowledge and research. So you have to make sure that even when you think you know, you go out and seek advice, because it will always go a long way in helping you. Now, but any investment you do, do not get into the habit of not going through with it till the end. Most things that we do start to pay off at a certain point after compounding. Let me give one example, and I'm going to use an example of farming. I had a case where back in the day, an uncle of mine comes to us and tells us, ginger, Ntangauzi is now very, very profitable. Kenyans are buying it all over the village, and you need to give me some money. I plant this thing, and then I will be home and try. We asked him, but is it a seasonal demand, or are you confident it will last until when yours are ready? He said he was confident. Long story. He invested, and the money, only about 40% came out because the market had shifted. When we asked the person who was successful at that ginger, he said, but you see, I've been planting ginger for 6 years now, season after season. There are seasons where the price is low and where it's high. But this one time, the price was spectacularly high. And that's how I've been able to make a very good return on this particular investment. So it's important to make sure that you are aligned from that point. Anything you do, once it is well researched, well appreciated, and it aligns with your investment strategy, risk appetite, and your capital buffer, you give it time. You give it time. If it's a kindergarten you're trying to build, or a school, you should know it's going to take time. If it's a restaurant you're going to set up, you should know it's going to take time. Even investments in financial markets do take time to actually mature. Sorry, I think I lost you there. So just to give a recap before we get into the case studies, just a recap of the wealth management equation and the system that you need to follow. Firstly, you need to have income, but once you get an income and you have a job or any form of income, in your planning, you should split your money into different accounts. There is money for your expenses, money for your savings. But when it comes to investment, you consider your risk profile. You consider you consider which investments are suitable for you, and you be patient with them. You want to benefit from the compounding aspect. And when you're younger, your risk appetite is higher, simply because you have a longer time to recover. When you're older, your risk appetite will be lower. But once you follow through this properly, you will find that you make a good case for retiring early and retiring happy. Wealth is mostly, of sustainable financial freedom is mostly, by the way, behavior driven. It's like how you see doctors. The wisest and most brilliant of doctors is not necessarily the healthiest person. So knowledge is one thing. Putting it into practice is actually the magical point. So having the behaviors, adapting to the behaviors is very, very important. If you have one person who is a high income person, say they earn 20 million shillings, and the other is a moderate income person earning, say, maybe 7 million shillings, you can easily find that the 7 million shilling person who is disciplined is going to end up with a far better, a far bigger net worth than this other person. Now, two things before we go. Questions is the power of compounding is massive. And here's why. If I'm investing at a return of 10% and you're investing at a return of 12% and you invest for at least 15 years, 15 to 20 years, the difference is not going to be 2% in our performance when we're done. It's not even going to be 20%. That difference of 2% will grow after 15 years. It will be almost twice. After 25 years, when you project it, it will be more than 3 times a difference. So meaning if I invested at 10% and you're 12% and I'm investing 1 million shillings, after 25 years, I have, say, 3 million shillings, but you actually have 9 million shillings. So the difference there, so meaning the discipline held over a longer term is going to make you extremely, extremely successful. As an action plan and takeaway as you try to embed this into your personal discipline and into your personal life, you need to, track your money every month. We used to say that what doesn't get measured doesn't get achieved. What you measure is what you get. So if every day you say have a goal of saving up to 1 million shillings, and every day you compute how far you are, when you have 1,000 shillings, you write it. When you have 2,000, you write it. When you have 10,000, 20,000, 200,000, when you drop from 200,000 back to 80,000, you write it. You'll find that because you're tracking that, you're definitely going to achieve that goal because you are patient with yourself and you're going to get to that level. If possible, try to automate your savings so that your money, once it arrives, you know which money goes to protection, to say an insurance, which money goes to say financial market investments. So a unit trust that you're saving up so that you can be able to buy a bond or you can be able to go invest in land. You need to build an emergency fund. It's not within our culture in Uganda to build an emergency fund. We tend to believe that when I'm sick, I can call home, or when I'm sick, I can call my husband. When I'm sick or when this happens, I can always call a friend. But it's important to where the world is going now, even our country itself, you need to have an emergency fund of at least 6 to 12 months to cover your living expenses. Yes, you don't want to be looking to someone to give you money for yaka, which is also going to get done after a few days. You need to define your financial goals and also your investment targets, which would ideally sit within what we call an investment policy in this case. That's the brief of my presentation. I would like to now just make it interactive to sit the floor and then get to hear remarks or questions, and then we get to address those.
Thank you very much, Mr. Bukomeko, Godfrey. Thank you for that session, and we can see a couple of hands are being raised. And this is your opportunity to engage, to seek clarification, to share any reflections that you've had on the presentation. In case you have a practical insight that you want to bring in, this is the time to do that. So I am seeing a hand raised by Charles Sentongo. And so I'll ask the person to unmute. Yes, Charles, you can come in. It seems Charles is not available. We can call in the next person. James, please do come in.
Hello.
Hello?
Yes, yes, James, you can speak.
First of all, I want to appreciate our presenter today has presented on a very, very, very nice topic, which is concerning our lifeblood, our life. And in fact, to be specific, my interest is on investments, especially the long-term investments, and especially on the corporate bonds, on the bonds. This okay, let me say on fixed income. My interest is on bonds, but I don't know whether he can give us more light, because I think, to me, it might be better investment, especially for some people who are too busy. Maybe you are at work and the work is really not giving you time to involve in these private businesses here and there. But if you put your money in fixed incomes and then it keeps on giving you some interest income probably every month, that would be nice. But if you can throw more light, because Godfrey seemed to have got a really enough experience. He was speaking more of being practical, and I like it. I like it. He was not so more of theory, but he was so much more practical. So maybe you can give me a practical case scenario on the issue of this bond, such that maybe I can have more light, sir. Thank you.
Yes, thank you. Should I take that at this point?
Yes.
So you give a very good example. So and I want to bring this home very nicely with practicality. So you have a job. The job pays you well, but takes up your active hours. So you don't have enough time to go into private business. Now, even people in such an can actually build well in such a platform. But what you need to be cognizant about is, firstly, one, when it comes to treasury bonds and corporate bonds, they are fairly low risk instruments, and therefore they benefit one person who has significant amounts of money invested. But for you, then you need to build a portfolio that is, yes, partly corporate bonds and fixed income bonds and treasury bonds, but also you need to look into equities. However, you have to start from where you are. And I'm going to give a scenario here. One time, about a couple of years ago, maybe 6 or 7 years ago, I was in a bit of a similar situation, and and what we agreed, me and a friend who was also in the same situation, was that we would join a club, an investment club, where we would put money, and then at the end of, say, 6 months, we would go rebalance how much money we have obtained or been able to save, and then go push that money into one of the investments, either one bond or in a share, in a stock of a company, or anything within the financial markets. So what we did, that particular club that we joined was asking us to save up to 750,000 per month. But the advantage was, if you saved up to 10 months, then they would give you'd have saved 7.5 million, but they would then give you up to 15 million. And the extra amount you'd pick up would only be picked up at about 10% for the entire time. So 10% for the year as the interest on that particular loan. Now, why we took on that was, one, none of us had this money saved up on our accounts. So meaning we didn't have the discipline to actually save this money and keep it for the 10 months. So we started to put in the 750,000 per month. 10 months later, we both had the 7.5 million as as a stake in that particular saving group, and we both got the 15 million. Now, once we got the 15 million, we invested actually in a bond, and we held it there. So we now were working. We knew that in 1 year, this bond was going to pay us enough money to cover the interest on that amount of money, but we're also going to be able to pay off that loan and be able to qualify for another 15 million. Interestingly, it didn't take us another 1 year to achieve that. About 4 or 5 months later, we had paid off the loan and we qualified for another 15 million. So we then got that 15 million and added on to our bond. Now we each had a bond portfolio of 30 million shillings. Now, a bond portfolio of 30 million shillings was not only able to pay off a significant chunk of the 7.5, it was also able to pay off the interest. So we kept on doing that until about 3 years from the time we started that particular program. We each had 100 million shillings. Now, we were able to put this together simply because we developed a system and then got the equivalent of a unit trust in a circle where we would put the money on a monthly basis. Now, at the time, we had a third friend of ours who considered our system to be too simplistic, and he didn't like the gymnastics of that particular saving group. He thought they were going to steal money or anything. He created a bit of a negative vibe or bias around it. When we finished, he came to us and he wanted to borrow. He had a function. He wanted to borrow 10 million shillings. So we sat him down and said, okay, now you want to borrow 10 million shillings from us? That's fine. Do you have the 100 million that we have because of what we've been doing? And key to note, he was earning twice per month than we were earning. He didn't have the money. So we lent him the 10 million shillings at 15% per month. So we did loan sharking. Now we're diversifying our 100 million shillings now into a high-risk investment. But he also gave us his car as collateral, so we de-risked that particular transaction. I'm giving you a practical scenario here. My other friend proceeded to go and buy land with that 100 million shillings and continued with the program. I also proceeded to do other investments. And where he bought land, he got a mortgage to construct. He took that route. Me, I did not want to take debt. But you can see that even someone who is sitting behind a desk is able, if they can only master the discipline, is able to also build up a whole portfolio that can, in 5 years, even surprise themselves and surprise their actual people around them, like the peers. Like I mentioned earlier, we always overestimate what we can do in 1 year, but we overestimate what we can do in 10 years. When we projected at the 3-year point, we projected that actually, if we kept on that discipline, 10 years later, we could each have at least 500 million, which was, at the time, difficult to fathom, difficult to think or believe. So, one, I think for who are employed, there is you can put money in a circle, but there are also voluntary saving schemes that are within our different that our employers tend to give us. Then there are just a couple of mechanisms that one can use to make sure that if you are not disciplined enough to put money in a unit trust and leave it there, then join a group where if you put money, they won't allow you to remove it. Meaning when you have a problem, you have to go elsewhere. If you're hungry, you can wait until lunch the following day. So you don't need to borrow money to eat because you're not going to be able to get that money from where you invested it to be able to take care of that. So that over time, you find that you start to gain an edge over everyone simply because you've been able to go through the pains of, say, an 18-month, 24-month, 36-month discipline cycle. It's very, very important that you take that route. Now, how do you get to invest in bonds and corporate bonds? That discussion is a little lengthy. It depends on portfolio and where you're seated, but whenever you're ready, you can always get my details. You can come to office. We give this advice for free. We can get to walk you through what you need to do and what you shouldn't do, and how you can get on that journey. But it's important you always work with an investment advisor. Even when you have money, which for you might consider little, you must get an investment advisor, because the knowledge you get when you have 1 million is the knowledge that will save you when you have 100 million. Simply because on that journey, you're not only saving money, you're also accumulating knowledge, and you will know how well to allocate money, as and when and how. Thank you.
Thank you, Godfrey. We have another hand up. Nicholas Mugabe has a question, but we also have some questions in the Q&A chat box. But allow Nicholas to air out his question. Yes, Nicholas, please do come in.
Good afternoon. Thank you very much for the presentation. Just to take you back shortly, what's the difference between the treasury bonds and the corporate bonds? And maybe your contacts, say that if you have to get more detail. Thank you very much.
Thank you, Nicholas. Godfrey, would you like me to ask the other questions in the chat so that you can answer, let's say, about 3 questions at the same time, if that's okay?
Yes, I've also not had Nicholas' questions very well.
Oh,
If you could also
okay.
reiterate the same, that would help.
Okay. Yes, Nicholas, please come through once more.
Thank you very much.
You're not so
what's the
audible. That's a challenge.
Can you hear me now?
Yes, I can.
Yes. What's the difference between treasury bonds and the corporate bonds? And the next,
Okay.
share your contacts, just in case I want to follow up with a few issues you have raised. Thank you so much.
Okay, Godfrey, he's asking what's the difference between treasury bonds and corporate bonds, and he's also requesting that you share your contact, I think, and your location, which you have done in the chat already. Let me just copy this and put it in the chat for everyone, and so you can respond to that.
Yes, thank you. So there is only one key difference. A treasury bond is issued by the government of Uganda. A corporate bond is issued by a big company like an SME or a big entity like MTN within the market, or like a bank like Standard Bank or Absa Bank or Standard Chartered Bank. So when you're investing in a corporate bond, you're normally taking the risk of that particular issuing entity. Say we have corporate bonds that were issued by Hachira back in the day. We have corporate bonds recently that have been issued by EABL in Nairobi. We have corporate bonds that have been issued over time by different entities. So, and these corporate bonds, it's just a way of the company to raise debt without going to a bank. And they come to the normal market to raise this particular debt. Now, for treasury bonds, those are strictly issued by the government. Thank you.
Okay, and so we have other questions. Let me read them out loud. The very first one, it was at the beginning of the session. When I invest my car comprehensively for 10 years without any claim, the money will buy a new car. Is the risk insured, not making me poor just for fear of it? That was by Ambassador Anthony Tibayingana. And then another question is, I'm hoping you have access to these questions. That's why I'm reading them out loud. Another question by Agatha Tumwine. I have seen people in a group sell land to invest in a unit trust. Is it really a wise decision? That's a very good question. And also one by Susan Babazi. challenge with long-term compounding is the risk of inflation. The value million today is not the same with that million 10 years later. What do you have to say? So I think you can respond to this. We have 2 more coming in the chat. Yes, Godfrey.
Okay, thank you so much. So, very interesting questions, and thanks for them. So, insurance, motor comprehensive. If you show your car for 10 years, you take that the premium paid would buy another car. So the normal insurance rates for comprehensive for individuals is about 4%, which means every year you pay 4% of the value of the car on a depreciating, and you are free to depreciate that particular value. But assuming you don't depreciate it, that means you will have to pay for 25 years for you to recover the same value of the car, or to have paid the same value of the car. The purpose of comprehensive, though, is not, so it's not a profit-making strategy. It is a portfolio protecting strategy. So when you're doing investments, the things you do because you want to grow your investment portfolio, then there are things you do because you want to protect your investment portfolio. So in this case, the reason you take up comprehensive is one particular reason is for you to protect your investment portfolio and to also protect your cash flows going forward. But key to note, you're normally going to drive a car from between 5 to 7 years. And by the time you'll have paid out with the depreciating component, you'll have paid about 20 to 25% of the car because you're going to be depreciating it. And if you pay 20% the value of a car in 7 years, for you to protect yourself from an adverse event where you knock someone knocks someone, or you're knocked by someone, or you knock some wall or something, and then you have to, yes, you bought a car of 40 million shillings after saving up for a year, but now you all of a sudden have a liability of 20 million shillings in your hands, which can, so if you set up for a year to pay for a car of 40 million, chances are if you get a liability of 20 million due to that car, it's going to wipe out 6 months of your cash flows or of your savings. So you don't want to be in a situation like that. And in some cases, it's actually aggressive in that it can even wipe out a lot more than that. So the reason, or wipe out cash flows for, say, a year or 2 years. So you want to make sure that even as you drive, you're protecting your cash flows and your peace of mind. Now, I didn't say this earlier, but I'll say it here. One of the ways you make headway in your financial journey is by protecting your peace of mind. See, when you are not in a frenzied mode or in an anxiety mode, it will be easier for you to digest insights or digest information and come up with good insights that you will end up allocating money properly. So you won't be in a rush. Then the question of, is it good for people who still learn to invest in a unit trust? Sometimes saving groups, what they face is a liquidity crisis. So we, as a group, when we are starting out, we put money together, put that money in some piece of land, then down the road, 4 years later, we've invested in 100 million. It's now worth 400 or maybe 300 million because we bought in a strategic area and a road came and electricity came and this came and that went. But at that point, we all need liquidity to run our lives, or we need this particular service to now become of use to us. Now, in such scenarios, what you're going to need, most importantly, is a unit trust so that you can have that money still invested, but while you're still giving liquidity to the members. Say a unit trust may be giving you 12% return, but you could be lending to the members at 1% a month, which is a very low maybe return level, and then they're borrowing against what they have in the scheme. And to achieve that as a value proposition to the members, you then have to then put money in a near liquid asset such as the unit trust. that aside, a time is coming where land investment in Uganda is becoming a bit tricky, mostly because of what's happening within the legal space and other areas. So saving groups are going to have to diversify their thinking or their approach in terms of investments that are outside of the financial market space. So, and this diversification is just to really address the aspect of where are they investing and what's the risk on those particular investments. Isn't the rise of inflation a problem for compounding? So inflation is addressed in portfolios or investments by making sure you're earning ahead of inflation in the short term. Say, for example, if inflation is 5% for Uganda, that means you need to earn at least maybe 10%, so that when your portfolio grows after compounding to be from 1 million to 10 million, probably inflation has eaten away a value of about 4 million. So your actual return is the 6 million above the 4 million shillings to make your total return at 10 million. So if you outperform inflation in the 1 year period, your portfolio will also outperform inflation over whatever period you're compounding. That's how you address the inflation. But if inflation is 5% and you get into an investment that returns less than 5%, then yes, inflation is going to be taking away value from your investment journey. So as you build your finances, you have to make sure you're always earning a return above inflation. And okay, yes, I hope I was actually a bit clear on that.
Yes, you are. And if it's okay, I would like to ask a couple of more questions that have been put in the chat. There's one by Brian from Sedat. Thank you very much for the enlightening presentation on wealth creation and management. I found it very informative and insightful. I have one question regarding risk profile. How does one determine their personal risk profile? Apart from age, what other factors influence an individual's risk profile? Specifically, what factors increase or reduce a person's risk profile when making investment decisions? That is from Brian. Then there's a comment from one of our members who said, is it possible to speak in ordinary language, because there are colleagues who are not understanding some terms, for example, portfolio strategy. That is just an insight as you're responding to these other questions. Then another person, this is anonymous. Please expound more on equities. I do not think I have understood them. What are they and what examples do we have in Uganda? That's an anonymous attendee. And also, under what circumstances should one invest in treasury bills versus unit trusts? Why should I invest in treasury bills yet the yield is lower than unit trusts? That's a good question. Yeah. So you can respond to that, and then we can call on Dathan, if that's okay.
Thank you very much. What are the factors apart from age? Firstly, when you're assessing your risk profile or how much risk you can take on, you need to sit with at least a financial advisor so that you at least appreciate where you're coming from. But there are things that you can consider. For example, we do consider how long you're happy to be invested. We do consider how much money you have. Now, you see, when you have certain money, say if you're extremely liquid, you can take on bigger risks. If you don't have much money, you cannot take on bigger risks, because the people with more money, they're more comfortable with waiting for the investment to pay off, even if it's after 10 years, so they can take on more risk. So even your income level matters. In some cases, even your health matters and your sex. So you find that oftentimes the risk appetite for men and women is not the same, but all of these factors can be considered and more when you're sitting together with a financial advisor. Why should someone invest in a treasury bill instead of a unit trust? In most cases, given where market is, okay, it depends. There are times where unit trusts are performing better than treasury bills, such as now. But there are times where treasury bills are performed better than the unit trusts, such as sometime last year. Sometime last year, unit trusts were averaging 13% and treasury bills were doing 15%. Of course, this is before you consider taxes. But if you consider taxes over time, unit trusts have done better than the treasury bills. And also it depends on your portfolio and how you want to diversify that portfolio. And also your tax exemption status. But there are times where about 6 years ago where treasury bills were yielding about 14% and unit trusts were doing only about 10%. So you find that either that in those scenarios, the treasury bills were doing better than the unit trusts. But that has since changed because of a couple of changes and improvements in the market. That's why now the unit trusts are actually performing better than the treasury bills. I hope I addressed all the questions.
Yes, you have. And then we're going to have the question from Dathan Bonavie. After he's done asking, I'll be able to read the other questions. Yes, Dathan, please do air out your question.
Yeah, so 20 years to retirement, and I'm here asking myself whether I should be investing in land, building Mizigo, whether it should be looking at unit trust and bonds and that kind of stuff. Could you speak around that and tell us the advantage of money market investments over the traditional, our forefathers' investment decisions of land and Mizigo? Thanks.
So thank you, Dathan. So when it comes to the choice between land and financial investments, you see, land is still a resource and a key factor of production. It has its different metrics and areas where land actually would give you a better return than what you get in the financial markets. If you have the proper land use case for it. Most people that invest in land invest from a speculative level, not from a use level. For example, if you simply bought an acre of land in Gaza today and said, okay, it's 100 million today, I project in 10 years, it will be doing 3 times. So you buy the land, you maintain it, you put maize on it, you keep on visiting it every now and then. If you factor in the cost of maintaining that land and the caretaker and the person who is there to make sure the LC knows you own it and everything else, you find that after the 10 years, you put 100 million and an extra 50 million to keep it, and therefore you get 100% after 10 years. Well, in such a case, you're being speculative. You could maybe sell it for 300 after 10 years, but you could also sell it for 1 billion because government may come and they want to buy the land for some reason, or I don't know. So whatever reason you have at that point, it is not set in stone. So either way, your reason is not in proper reasoning. It is speculative. But if someone then buys land today and they want to put on coffee, let me use a scenario that is actually very popular nowadays. You find that coffee after 4 years, the land has appreciated in value. That's one, but they have cash flow coming from that land. Say it was 1 acre of land, maybe they earn 20 million from it every year. So they bought it at maybe 80 million shillings, and now they're getting a good return, more than close to 25% return on it, and they're having to also get in the capital gains. So 10 years later, if they still maintain that coffee plantation, their return will be significantly higher than what they'll get in the financial markets. But there are other inputs in that case, and the inputs are coming in from the land use. Now, our traditional investment strategy from the forefathers related to mostly the land use. If land was owned, it was owned for purpose, grazing cattle, for banana plantations, coffee plantations, and everything else. And that land use created value for the family set. Now, in a modern setting where you are mostly in Kampala, you barely go to a village. You go there for funerals, for last funeral rites. You go there to visit the old people when they're still alive. And if they're not, you're probably going to go there for December gatherings. Chances are, whatever money you invest in that land, you're going to still maintain because you're going to hold the land, but you're going to lose a lot more money along the way in trying to maintain it. And whatever you invest there is not going to come back. It's more or less, when you do it, you consider it actually charity. Now, if you are at a certain level of wealth, like I mentioned earlier, your investment, someone who has more money can make investments out of investments that are simply going to speak to their cultural value or their ego or something of the sort. One time I was listening to Dr. Patrick Betature, and he mentioned that he has cows in, I think he mentioned Duchenne, somewhere there. And after doing the math on that particular project, he did not have a return on it. But the reason he still maintains the cows is because of the cultural value that they carry. But I know people who actually make money out of their cow cattle projects. But these people consider them investments. They are sitting there full time. They've tried to automate the dairy process. They've tried to do a couple of things to make them modern farms. But that simply means they are working hard to make sure that the use case is efficient. That's when it actually makes sense. So you can allocate depending. Do you invest in land if it makes sense? It will only make sense for the use case. If it is speculative, then probably you have information that other people may not have. For example, recently we saw that they're trying, in the papers, I think today, that they're trying to put a hotel in Imbarara rather than airport in Imbarara. People who come from that area, I think Nyakishara, something like that, probably speculated and bought land there. And in 5 years, whenever that airport project does get to take shape, maybe then the land will go up in price, say 5 times or 10 times. But that is very, very speculative, depending on information that you have. And that may not be worth going into unless you're putting a portion of your portfolio that is so minor, you do not mind it being seated there for a long time. That aside, when it comes to commercial real estate within Uganda, within the Kampala, it remains attractive, mostly because of the landscape that we have. So there's still housing demand. There's still a couple of things that one can do even here. And if you build and sell, your returns can still be competitive. But if you don't have all of that time, then you find that financial markets are quite attractive. And now that I recall, someone asked, what are the examples of equities and stocks in our markets? We have a whole Uganda Securities Exchange, which has about in excess of 19 counters, but the most popular ones are such as MTN shares, Airtel Uganda, we have Stanbic Bank shares, we have the Quality Chemicals, we have Uganda Plays. There are a couple of them that are actually trading, and anyone can get to participate, but you have to do that in consultation with your investment advisor. Thank you.
This will be the last set of questions, Godfrey, that we are taking. We have a couple. I think you've already answered something to do with what Terence Amoki has asked. How do we safeguard against inflation when we invest in liquidity like unit trusts? Maybe you can just throw more light on that. And then Patrick Mwase has asked, how can I identify and decide on a good unit trust for my investment? Then Jude Sebuufu has asked 2 questions. Kindly share light on the average interest given on unit trusts, government bonds, and treasury bills to inform our potential decisions. And then with, let us say 100 million, would you advise investing in unit trusts or bond or bills for like 5 years. He wants a practical example of 100 million and what decision someone would make in terms of the instruments that we've talked about. And then Joanna asks, hello, I want to build Mizigo and I have land but no money. Should I look for a development partner? And if yes, how can I get a development partner? And then the final one is James Ninsima, and there are a couple of questions. I'm 53 years old and approaching retirement. Is a unit trust, particularly a money market fund, a suitable instrument option for someone at my stage of life? And then given Uganda's current economic environment and concerns about high public debt, how safe are money market fund investments? If Uganda experiences a significant economic downturn or recession, how would this affect my investment? He also asked something about the value of the investment falling. Who bears the risk? Is it the investor? Is it the fund manager or another party? And what measures are in place to protect the investor's capital in unit trusts and money market funds? And can the investor lose part of their principal investment? That was such a heavy question, Godfrey. Good luck with that. Please do come in.
Thank you. Thank you, Rebecca. So I'm going to say this. A couple of the questions that I asked now are quite personal. And this is the point where getting to sit with an investment advisor does carry much more value. If you don't mind, I'm happy to get in. You can get to share my details with these people, including James, and then we get to meet and then really discuss. Even for Dathan, just appreciate where each one is seated individually and what they would like to do now. But for people who have. But for the question of the person who was, even for Joanna, who has land and is asking whether they need an investment partner or not, a development partner or not, it's more critical to sit down with them and then advise on what we know about what's happening in the market and what they need to do differently or better and how that could get to flow. If you don't mind, that would actually be my response. It will be very... I would be able to give them a lot more insight than on the time that's allocated for the call.
Yes, that would be okay for those specific members. Hopefully they do not mind. Maybe for those other general questions, like maybe how do we safeguard against the inflation? For those other questions that seem to be a little bit general, you could respond to those, and then we can close the session.
Allow me respond to the part about inflation. Whether it's safeguarding against inflation, there's only one solution. You just have to invest in a way that you earn above inflation. That's all. Anything you do, if the returns are below inflation, then you're losing. And the good thing about our market, a lot of the investments are earning above inflation. Apart from the riskier investments such as the equities, which can actually deliver negative returns, but fixed income returns are all they're all benchmarked against where inflation is and where the central bank lending rate is, which are all competitive. So your eventual return will significantly be above the inflation level. I think the rest of the questions are actually uniquely personal, and please kindly you share my details so that I can get to have a chat with those different people.
Yes, thank you very much, Godfrey. This was such an insightful session. I've been able to share Godfrey's contacts in the chat. Please check out the chat for these contacts. Also, feel free to complete our feedback tool. Godfrey, we've learned a lot from tracking savings to automating transactions to how to leverage the different financial markets to ensure that we grow our wealth. So Thank you very much. We can give Godfrey a round of applause. Please use those clapping icons in there. You can say thank you in the chat. And then you can always reach out to Godfrey, who has shared his contact details. Ladies and gentlemen, as we approach the end of today's session, it is my pleasure to invite our very own co-opted member on the MURBS board, Dr. Sol Nsubuga, to give the closing remarks and officially bring the session to a close. Let's welcome him virtually.
Thank you very
Yes.
much. Thank you very much, Rebecca. Mr. Godfrey Bukomeko, I would like to, first of all, appreciate you very much for taking us through this very important session for the members of Makerere University Retirement Benefit Scheme. It is called a sensitization activity because it helps us to learn to do things with our finances as we get older. You have said so many important things, really, and personally, I've learned some of them. One of them that is really critical for me is that high income does not translate into high net worth. It is very possible that I have a very reasonable income, but at the end of the day, if I don't make the right choices, and your session is actually aimed at helping us making those right choices at whatever stage we may be on this journey of our lives. You've given us a number of useful steps. For example, you've asked us a very important question: how can our lifestyles survive if our current income was stopped for some reason? That is a very, very important question to all of us. You told us, you've given us, for example, the framework that each investor needs as they begin or as they continue on this journey of investment. These are very important principles for us members of MURBS, because MURBS, one of the things MURBS is trying to do is to ensure that we retire with dignity. So even when we get this lump sum at the end of our term here, of our work here, of our tenure, it is possible that we may not make a good use of it, and we do not retire with the dignity that is expected of us, that is expected of a member of Makerere University. So this talk has equipped us very well and has given us key principles. You have said something that really I thought was very important for us members to note. For example, you say that we always underestimate what we can do in 1 year, and we don't think so much planning for that 1 year, but we overestimate what we can achieve in 10 years. Okay, this is quite a dangerous thing for us. Members, let us always recognize that the time to invest is not the whole length of the 10 years that we may be having for retirement, but right now, in the time we have, it is time to invest. And that the knowledge you need to accumulate 1 million is the knowledge that will save you when you have 100 million. The Bible says in John 13:17 that now that we know these things, we will be blessed if we do them. So I'd like to thank you so much for giving us this information and this knowledge. And members of MURBS, now that we know what is good for us, we shall really be blessed if we put this knowledge into action. So on behalf of the trustees of MURBS and on behalf of the members who have benefited from this session, I wish to thank Mr. Godfrey Bukomeko for sparing time to prepare and to come and be with us and to give us this useful information. Thank you so much. I hope your employer, OMIG, is able to reward you much more than us. So thank you so much, Mr. Mr. Bukomeko, and may God bless you. Did you say that I have to close this session as well, completely?
Yes, please.
Oh, I've been promoted. Members, I take this given honor to declare that this session has been closed. Thank you very much.
Thank you too.
Thank you too. Thank you, everyone.
All right, bye-bye.